Hello guys, welcome back to tutorial for consolidated financial statements, specifically financial position. We are continuing where we left last time. Last time we stopped here in group retained earnings, but we are getting into the new slide, which is intragroup trading. But what is intragroup trading? You know, sometimes for you to get the meaning of something, you need to split the weights. Split the weights. Like in this case, the word intragroup trading. The word trading means doing business. The word group means two or more. The word intra means within. Therefore, in short, intra-group trading means trading within the group. That's it. Trading within the group. So there are different ways of intra-group trading, where parent and subsidiary may trade with each other, which may lead to the following problems. Current accounts between the two parties, loans held by one party in the other, like maybe the parent loaning the subsidiary or giving the subsidiary the loan, dividends and the loan interest, unrealized profits on sales of inventory. Here, unrealized profit, we'll talk about it specifically towards the end of this session. And normally, the trading between the companies, it happens like in any other normal trading business with which might happen with a third party. So the parent or subsidiary, they might sell to each other goods on credit. By doing so, it will trigger or it will make or it will result in receivable in another company and payable in another company, which means the one which is selling will recognize a receivable and the one which is buying or purchasing will recognize a payable, because it will be owing the other company. But this amounts owing within the group. Remember the word intra. Within the group than outside of the group. They must not appear in the consolidated statements. In short, we don't want to see these amounts being part of consolidated accounts, or we don't want to see them when we are putting together the accounts for the parent and the subsidiary. So, in short, they must be cancelled. We will see how we cancel such transactions in upcoming slides. So, intra-company trading may result in, by end of the year, it may result in cash or goods in transit. Current accounts may not agree owing to the existence of in transit items like goods or cash. Like for example, let me say by the end of the year, the subsidiary is still owing, which is appearing on the books of the parent as a receivable. But at that time, the subsidiary has maybe released the check. So after releasing the check, obviously they will clear the amount or remove the amount owed on their books. But as long as the check is still on transit or it hasn't reached the office or the premises, or it hasn't been receipted by the parent, the subsidiary will still appear as a receivable on the parent's accounts. Therefore, it will cause some imbalance, because the subsidiary will have released the check, but the check is still in transit by the end of the year. Or maybe they have made some transfer, but the transfer is still pending. But on their books, obviously, immediately when they make the transfer or when they make the check, they capture that, or they record that they have paid the parent. But as long as the parent haven't received the check or the payment, they won't clear the amount owed by the subsidiary. So, which means at the subsidiary accounts, it will appear as zero, but at the parent account, it will still show that subsidiary is still owing the parent. Therefore, that's one of the problems which are caused by intra-company trading, especially at the year end, when a master reconciliation has to be made, or the final reconciliations has to be made. If the goods or cash are in between subsidiary and the parent, make the adjustment entry to the SFP of the recipient. Note this, of the recipient, because like I said, the company which released the money, obviously they would have captured, or they will have recorded transaction as if they have paid the creditor, but the creditor may that time haven't received the payment. So that's why here it is said make adjustment in the accounts of the recipient. We assume that the recipient is within the group. It's one of the companies in the group, of which here we assume the subsidiary. For example, like I was saying, the subsidiary has released the check. It's still on transit, yet to reach the parent. So what we do by the end of the year, if the parent hasn't received the check or the cash, we debit it. We debit on the books of the parent. We debit the amount, the cash in transit. Then we reduce the receivables. Remember, receivables have a debit balance. Therefore, if they are being paid, you capture opposite, credit. That's why debit cash, then credit receivables, to show that the receivables are reducing, or you are receiving the money. But if it is goods on here, it is for cash or the payment. But here, the goods in transit, same story. The goods may have been dispatched by for example, the parent to the subsidiary, but the subsidiary hasn't received the goods at the premises. Maybe the truck is still on the way. By the end of the year, what we do, we will assume that we will receive those goods by doing what? By debiting them in our inventory, capturing them. Remember, inventory is an asset. If you debit, it means you are increasing. We will increase our inventory and put trade payables, because once you receive the inventory which you owed, it means just correspond with the receivables, with the payables, to say the same amount. It has to reflect under the trade payables in the books of the recipient. Remember, not the issuer, but the recipient. Okay? I guess these are simple, basic double entry which shouldn't trouble you. So, these adjustments, they are just made for the purpose of consolidation. Like I was saying, we will just be doing so even if we haven't received the actual cash. It's still on its way, even if we haven't received or captured the inventory. But we do so because it's the family trading. We assume that no, the goods are going to arrive. We can say no, we will only capture when we actually receive them. No, we are a family. It's a subsidiary, so we assume as if the transaction has occurred for the sake of reconciliation or for the sake of consolidating. So once an agreement, the current accounts may be contracted or cancelled. This word contra means to cancel as a process of cross-casting the assets and liabilities. Casting means adding up. Remember, in consolidation, we add line by line assets and liabilities, line by line, except the equity section, where, if you remember well, we use the share premium and share capital for the parent, and we add the earnings for the two parties. Then this non-controlling interest. Yes. So this means that the reconciled current account balance amounts are removed from both receivables and payables in the consolidated statements. Yes, like I was saying earlier, these balances are not, or they are prohibited in consolidation. They must be removed. They must be removed because they are family trading. It's like trading or selling to your sibling. You can't really say you made profit, and you can say you are selling what can I say? Maybe you are selling your car to your father, or your father is selling you his car. Because if your father is selling you his car, and then with that money he renovates the house or builds the house, which we are still going to use, it means that that transaction, it doesn't benefited the family, because the car is still within the family, the money was used within the family. Therefore, we assume that there hasn't been a transaction, So it's same thing here under consolidation. So we have what is called unrealized profit. Profit made by members of the group on transactions with the other members. Like I just said, your father selling you a car and still he can use it, and the money he got from you, he renovates the house. It means there hasn't been a real gain. So in this case, there's no profit made unless if the car was sold to an outsider or someone who's not part of the family. So same thing here. Unrealized profit occurs when there is a transaction or transactions between the group members or within the group, and those goods are still within the group. Note this: it occurs when the other party within the group sell something to the other party within the group, and those goods are still within the inventory of the receiving party, waiting to be sold to the outsider or to a third party. Okay? Therefore, the profit which was made by the parent may be selling to a subsidiary. That profit, as long as the goods are still within the premises of the subsidiary, the profit is said to be unrealized. It is only realized when they are eventually sold to the outside party or outsider. So, that's the story with the unrealized profit. Recognized in the accounts of the individual companies concerned, but in terms of the group as whole, such profits are unrealized and must be eliminated from the accounts. Such profits are unrealized. Remember, I said the profits, they are only going to be realized when those goods are sold to an outsider. And in the previous slide, I said intra-company transactions are void or must be cancelled or must be eliminated. So same as unrealized profit, it must be removed from that party which sold or that party which gained the profit upon selling. Whether it's the parent selling to the subsidiary or the subsidiary selling to the parent, that profit has to be removed as long as the goods are still within the company or the receiving company. Unrealized profits may arise within a group on inventory where the company trade with each other. Exactly like what I just said, as long as the goods are still within the inventory, the profit is deemed unrealized. When one group companies sell goods to the other, a number of adjustments needs to be made. Current accounts must be cancelled. Yes, reversing the transactions where goods are still held by a group company. Any unrealized profit must be cancelled. Yes, we just said here, it must be eliminated. Inventory must be included at the cost to the group, i.e. the cost which to the company which then sold it. I mean, if, for example, we bought goods, let me say a parent bought goods from an outsider at a cost of 50 and sell them to the subsidiary with a profit of 10, therefore selling them at a price of 60. We need to remove that £10 profit and recognize the goods at cost, the very same cost or the initial cost which it was bought, or the initial cost which it was captured when it arrived in one of the group members who eventually sold to the other member of the group. Or the initial cost which the selling company obtained that or those goods at, like I was saying, for example, if we bought them for £50 and we sold them to a subsidiary for 60, we need to remove 10 pounds profit and recognize 50 is 50 will be the cost to the group until these goods which were sold at a profit of 10, until they are sold to the party outside the group. That's when that £10 will be realized, plus another profit which is going to be gained when they're being sold to a third party, because obviously they're not going to be sold at 60. The subsidiary is going to add their margin again and sell them. If, let's say, for example, like the question normally say, they can say half of these goods still remain in the inventory. It will mean that half of the profit is unrealized. Therefore, if the profit was 10, it means 5 is unrealized. Therefore, 5 has to be removed from the inventories or from the group inventories because it's unrealized. Or if they say 1/3 still remain, you said 1/3 times the profit which was added. If they say half remain, is the profit times 0.5 or times half. If they say 2/3 remains, the profit times 2/3, then you remove that. I think I'm being clear here. I think I'm being clear. No pain, we are just gaining. PURP stands for provision for unrealized profit. PEP. At UK they normally say it's PEP. This is just what we spoke about earlier or on the previous slide. This number 16. So here is just a summary of what I just talked about in a small example here. So the saying, let me just read it. Where goods has been sold by one group to another, one group company to another at a profit, and some of the goods are still in the purchases at the end of the year, then the profit loading on these goods is unrealized from the viewpoint of the group as whole. This thing is important. Viewpoint of the group. Remember, here we are working with the group or intra-company trading. In the viewpoint of individual companies, it will be normal, it will be realized. But under the group, it's called or is deemed unrealized. This is because we are treating the group as if it's a single entity. Yes, like I was saying before, they are like family. So family is one. You know, if we are family, it means we are one. So same thing here. The group, the parent and subsidiary are treated as single entity when we are consolidating, because we are going to add the individual assets and liabilities line by line. We're going to add them. So no one can make profit by trading with himself. What I just said. Trading with your sibling or trading with your father, you can't call that a profit, because at the end of the day, it's still within the family. until the goods are sold to an outside party, there is no realized profit from the group's perspective. Exactly what I said before. Exactly what I said before. So let's hear this example. They're saying Pineapple purchased goods for $400 and then sold this good to Satsuma. P is the parent and S is the subsidiary. So Pineapple is P, therefore is the parent. Satsuma is S, therefore is the subsidiary. During the year for $500, Pineapple would record a profit of 100 in their own individual statements. Yes, from that perspective, the statement of financial position of Satsuma will include closing inventory at a cost of 500 or at a purchase price. The situation results in two problems within the group. The profit made by Pineapple is unrealized. The profit will only become realized when the goods are sold to a third-party customer, to someone or to other company which is not part of the group. 2. The value in Satsuma inventory of 500 is not the cost of inventory to the group. Cost of the inventory, cost to the group was the purchase price of the goods from the external party of 400. Like I was saying here I was saying 50, the initial cost, 50 initial cost. So even here you see 40 is the initial cost. For 400, not 40, excuse me, 400, the initial 400. Yeah. So an adjustment will need to be made so that the single entity concept can be upheld or the consolidation can be performed. The group should report external profits, external assets, and external liabilities only. In short, everything which happens internal should not be reported in the group accounts. Okay? In the group accounts. Provision for unrealized profit. The adjustments for unrealized profit in the inventory. The process to adjust is determine determine the value of the closing inventory included in the company accounts which has been purchased from company in the group. The value of closing inventory included in individual company's accounts which has been purchased from another company in the group. Then you use the markup or margin to calculate how much of that value represents the profit earned by selling. Make adjustments. This will depend on who is the seller. So, for example, if the parent is the one which is selling or who is selling, the profit element is included in the holding company's accounts and relates entirely to the group. Remember, under the working of retained earnings, whatever profit which was made by the parent is recorded as it is 100% of parent's profit is recorded under retained earnings. Okay, that's what they're saying. Entirely, it relates entirely to the group. Remember, on that working I said under retained earnings is 100% parent's profit and then subsidiaries' profits times the controlling interest less payment of goodwill. So double entry is as follows. You debit group retained earnings, debit them, then you credit group inventory. Exactly. Crediting group inventory, you are removing that transaction which the parent sold to subsidiary. We are cancelling it because it will be appearing under the on the inventories of the subsidiary. So because inventories or inventory by nature is an asset, therefore it has a debit entry. By crediting it, there's a debit entry. By crediting it, it means you are cancelling. Okay? So we'll be removing that transaction. Alright. You got me? So if the subsidiary is the seller, the profit element is included in subsidiary accounts. It relates partly to the group, partly to the non-controlling interest. Remember, subsidiary is it will be having different shareholders, controlling those who have control, of which in this case we refer them to as a parent company, and those who don't have control, but those who have significant influence, or those who have less than 50% stake, or in short, or in other words, non-controlling interest. So we will debit the retained earnings, debit subsidiary retained earnings, deduct the profit in working 2. Remember, working 2 here is net assets. Then you credit group inventory. These are the same. Credit group inventory, we're just simply removing the transaction, because you know inventory is debit. Therefore, every time you credit, it's either you are cancelling or removing, or you are selling. So in this case, we are cancelling or removing. We are not selling. Okay. Adjustment for items on credit. I have spoken about it earlier. I don't know what it was. This slide number 15 or 16 for the goods. But for summary's sake, for cash in transit, we will debit the cash, assuming that it will eventually arrive because it's from our trustee, our sibling, or our partners in the group. We just record the cash as if we have received it, even if it's still in transit, and we reduce the receivables. Remember, receivables are assets, so initially they would have been a debit, but now they are being credited. Therefore, we are actually receiving the payment or reversing them. Same as the goods on transit, we will capture the value of the goods which are still on the way as inventory and recognize a liability for that goods which we are still yet to pay. These transactions, remember, they happen or they are recorded in the books of the recipient. Mark my words, in the books of the recipient, not the issuer, the recipient. Adjusting for items in transit is still the heading, but here we are cancelling intragroup transaction. How are we cancelling? Before we cancel, remember I said when the parent and subsidiary trade, especially on credit, it means that a receivable is recognized somewhere and a payable is recognized somewhere, which means initially a receivable would have been a debit, and a payable would have been a credit. Now, when we are cancelling, we are capturing, or we are recording, or we are doing opposite. If a receivable was a debit, when we are cancelling, we are doing what? We are crediting. That's it. If a payable was credit, when we are reversing it, we are doing what? Debit. As simple as that. As simple as that. I don't think there's pain here. Simple. Basic double entry from level 2. Mid-year acquisition. I think this part I should have maybe taught it earlier when I was doing net assets. I think the third, fourth or fifth slide, somewhere there. Sometimes, because here in consolidation, is the company acquiring the other company, then you consolidate the accounts. So it's not always that they will buy each other at the beginning of the year, and it's less likely that those companies, their financial year will be the same. Some companies, their financial year ends at March, some at June, some at September, some December. Therefore, in other companies' books, it might appear when is the year end of the other company. For the other company, might still be within the accounting year. Therefore, if the other company, the parent, purchases subsidiary or acquires subsidiary, which the accounting year is still running, it will be called a mid-year acquisition. And remember, we said after acquiring, whatever profits which arise after acquisition date, they relate to the group, or they relate to the controlling interest. So normally we'll be given figures at the beginning of the year for that company, for the subsidiary, and figures at the reporting date. And you will find that we purchase it somewhere, maybe on the ninth month, or on the 6th month, or 3rd month. But we need to consolidate. What we will do, we will proportionally split the profits, because we assume that profits accrue evenly throughout the year. In short, if subsidiary made profit of 12,000, we will assume that 12,000 divided by 12 months, therefore per month they were making 1,000. And if we acquired them on the 9th month, it means that we are entitled to the profit of the 10th, 11th, and the 12th month. Therefore, we'll only be entitled to 3 months profit. Therefore, if the profit is 12 months, it's going to be 3 divided by 12 times 12. Therefore, profit for the group, or entitled to the group, will be 3. If we acquired subsidiary on the 6th month, it means that we are only entitled to the remaining 6 months after we have acquired them. If we acquired them on the 3rd month, it means that the remaining months, which are 9 months to go before the accounting year ends, that profit relates to the group, and whatever profit they made throughout that year. For you to determine how much the group should take, it will be 9 over 12 times that profit. If it's 12,000, then 9 over 12 times 12, then it's gonna be 9,000, because here 1, here 1. 9 times 1 equals to 9,000. That's it. So thank you guys for this session. That's all with the consolidation of financial position. Before we do consolidation for profit or loss, we will go through an exam standard question of consolidating financial position. Till then, goodbye.